The number of Americans filing for unemployment benefits jumped by 78,000 this week to 439,000 total. That's the highest level in a year and a half. Since December of 2007, 5 years ago, weekly jobless claims have stayed above 300,000. And economists say that weekly claims have to fall consistently below 375,000, shown by this yellow line here, to show that the job market is strong enough to actually lower the unemployment rate in any meaningful way. Wall Street has seen a slow but relentless sell-off in recent days as well, down roughly 700 points since the election 10 days ago, more than 1,000 points from about a month ago. And there is a long list of reasons for that. Stu Varney with the Fox Business Network, host of Varney & Co. there in the mornings. Stu, you know, whenever I see the stock market, I think, I don't have any stocks. I'm not invested in any way. But anybody who has a 401k is invested, and even if you're not, that affects this economy. So put that in perspective. 700 points in the last week, 1,000 since last month. Okay,
first of all, you're right. It's not just the elite, that bunch over there, the rich, that own stock. All of middle America has a piece of the stock market, as you say, through their 401k, their IRA, their company pension plan. That's what pension plans invest in. We live or die by the stock market. Now, it's down 700 points since election day. That is a very significant drop. Connect the dots for a second. You've got bad economic news, the re-election of President Obama, and now the Wall Street sell-off. They are connected. You mentioned 439,000 new jobless claims. That suggests a very weak economy. Then you've got President Obama saying, we're going to tax the rich. No matter what, we're going to tax the rich. Then you've got the Congressional Budget Office saying, if you tax the rich, we lose 200,000 jobs next year. Add it all up, and then you have a Wall Street sell-off. And there's separate reasons why Wall Street is selling off. That is dividends tax going up, capital gains taxes going up. Connect all the dots, and you've got a spiral down.
Dividends tax and capital gains taxes, those are taxes people pay on the money they make from their investments.
Yes, okay. If I buy a stock for $100 and I sell it for $200, I've made a gain of $100. That is a capital gain. I'm taxed on it. I used to pay 15%. But in next year, it might be 20% or even 23.9%.
And the argument is if the tax on those capital gains goes too high, then you decide not to invest. You decide to put your money maybe in real estate or in the mattress or someplace else, and that hurts the economy not to have your money out there.
More to the point, if I sell now, this year, and pay 15% capital gains tax, that is much better than waiting till next year when I might pay a much higher capital gains tax. So I sell now. That pushes the stock market down.
You know, talk to me about the CBO report that taxing the rich more is going to lead to jobs, is going to cost jobs, because that's the Congressional Budget Office supposed to be this nonpartisan group. I mean, there's got to be another side to that story. Clearly,
they're the bean counters. These are the guys who get the numbers from the administration, put those numbers into an equation and say, right, this is what's going to happen. And this is what they said. You tax the top 2% of income earners at a higher rate. Get rid of the old Bush tax cut rates.
Yeah, but even just the rate that President Clinton taxed them at, because President Obama says, okay, you're going to go from 35% up to 39.6, and that's what you rich people paid under President Clinton. So
yeah, but wait a second. You do that. You go from 35 to 39%. That's a big tax hike on people making a lot of money. That takes $87 billion every year out of the private sector and gives it to the government. That means less growth. That means fewer jobs. 200,000 fewer jobs.
Sorry, it's not a good time to talk, but I never forget to turn this off. Sorry, Stu. That was a very rude way to end our segment.
I can take it.
Thank you.
Sure thing.